Alright, hi there, welcome back to another video. And as promised in my last video on Lululemon, there are a few more things I want to talk about. Let's start with US valuation. So let me just pull up the chart of the S&P 500 because we're pretty much back at levels earlier this year. So pretty much back to all-time high. So we started the year at around 5,800 points and we crossed the 6,000 point mark for the S&P actually quite recently again. So we're pretty much break even for the year. Year to date, the S&P delivered 2.3%. And considering the backdrop of everything that happened ever since early 2025, that's actually quite remarkable. So I'm not going to list all of the events that were unfolding so far in 2025. I think most of my viewers will be very well aware of them. But I think it can be summarized that the outlook for the US economy and also the international perception of the US as the anchor of democracy, of capitalism, of a spirit, a culture that is very much focused on entrepreneurship and everything related to being very efficient. I feel like there are challenges to that right now. And I'm not sure if the current valuation that is the same as heading into 2025 is reflecting that, quite frankly, especially given that the valuation entering 2025 for the US stock market was elevated, at least relative to historical benchmarks, as it was elevated. So a few things here. First of all, I wanted to show you a chart from Dennis Hong that he shared on X the other day that also supports what I was just saying. Give me a second to just pull it up. So he was sharing a table that basically compared, valuations across different countries, across different regions. And what we're seeing here is the current forward price to earnings ratio, and then also the 20-year median forward price to earnings ratio, and then as a percentage expressed whether we are looking at a higher multiple or a lower one. And as you can see, the US is the most expensive market on this list here, which I think is justified because the US market comes with a lot of characteristics. I sort of alluded to a few of them earlier that justify a higher valuation multiple. It is, or it used to be, I'll leave that up to you, like an incredibly stable democracy. Rule of law was always respected and defended by various institutions. Investors and businesses are always treated fairly. There are very strong incentives to create shareholder value for businesses, and obviously now we're talking about public businesses, but for private businesses as well. So I think a valuation premium, also if you look at the quality of the businesses that are publicly traded in the US, that's maybe the most important part. There's a reason for the premium to be justified. Very high returns on invested capital, which you can't find in Japan, for example, which is sort of going through a shift at the moment in terms of aligning shareholders' interests with corporate interests, and the culture that is embedded in that region a little more. But not only are we looking at the most expensive forward price to earnings multiples, we're also looking at the biggest discrepancy between the current multiple and relative to the 20-year median. As you can see, we're basically 34% above the mean here. Now, I don't have all too much to say here on top of that. What I will say is what you may want to reflect on. That's sort of the food for thought I want to leave you with here. I think it's maybe a time to consider taking some cash off the table here. That's not what I'm going to do because I'm already sitting on a decent amount of cash. I deployed a bit of it more recently, which I wrote about on my blog. But if you are fully invested right now, I think it's worth reflecting on whether you want to take some cash off the table right now that you have invested in public equities to have some more dry powder in case we experience another event like in early April, Liberation Day. I think most of you remember that quite vividly. I also want to point you to a blog post where I shared more in-depth thoughts on this topic and sort of the expected returns or the future expected returns in US equities. I wrote a blog post that was titled something along the lines of 3 probability lenses to assess future expected returns for the US. In it, I used, as the title suggests, 3 different approaches to estimate what kind of returns investors can expect over the next 10 years. I was, for example, looking at valuation multiples, just like Dennis Hong did in this table that he shared. I was, however, also looking at 10-year rolling returns that investors have experienced in the US over, well, multiple decades. And in fact, the last 10 years, if I remember correctly, has been one of the best 10-year periods investors ever experienced in the US. And chances are that the next 10 years will not be as favorable if you sort of consider this as a base rate. And then there was another probability lens, which I'm not going to cover right here. I'll display the blog post on screen right now. And I encourage you to take a look at it yourself after watching this video. Then what else? I have a few more things here on my little notepad here. So I was asking my audience for ideas to, like, things to discuss on this channel. One was the return on incremental growth investments concept that I recently talked about on my blog. Again, I'll point you to the post right here. But what the idea here is, just on a high level, would be that return on invested capital, so ROIC, and similar metrics like return on assets, return on equity, return on capital, what they try to measure is how profitable a business is allocating capital to fuel future growth. And strictly speaking, if you look at ROIC for a more mature company, is you look at the more recent earnings produced by the business and then you compare it to the invested capital of that business over time. And strictly speaking, that's not the most accurate metric to assess how profitable recent investments have been, because you're looking at all invested capital over multiple decades in some cases. So a better way to measure the returns that a business was earning on reinvested capital, say over the last 10 years, would be to just compare the current earnings power, or strictly speaking, the incremental change in earnings power today compared to 10 years ago, to the invested capital over that 10-year period. And then for the ROI, what is it? ROIGI, so return on incremental growth investments metric, I was going one step further and I was taking a look at the invested capital over that 10-year time period. And I was sort of estimating what portion of that invested capital was actually attributable to growth reinvestments, meaning the management team deployed that capital with the intention of growing the earnings power of the business, and how much of it is actually supposed or should be considered maintenance reinvestments, which basically only achieves that the business remains in the current competitive position it is in, if that makes any sense. And one final step I was taking here is I was not only looking at the capital expenditures of the business, so that would be a cash flow metric, which is usually used to calculate free cash flow, by the way. So to calculate free cash flow, you take operating cash flow, you deduct capital expenditures, and then you arrive at free cash flow. But there are multiple more steps that I think you have to take. And one such step would be to consider whether the business is maybe also reinvesting via its income statement. So on the income statement, for example, a company may be reinvesting for growth by investing in marketing projects. Many businesses like Novo Nordisk was the case study actually used on my blog, reinvest in R&D, so research and development. For Novo Nordisk and the pharma space in particular, this may be the most important and the most substantial growth lever, a reinvestment lever that they can pull. So I was considering all of that to come up with this new metric, which I think is a more accurate reflection of, well, the returns a business earned on recent growth reinvestments. All right, and then just finally, as I said in one of my recent videos, I also want to use my YouTube channel a little bit as a funnel to point people to my blog, where I allocate most of my time to right now. So I just wanted to raise awareness for the fact that I covered 4 stocks on the blog more recently, which I find all very interesting, which doesn't mean I'm invested in all of them. But you may want to check out some of these posts. So one post that is actually freely available is a post on a software company operating in Canada. It's Computer Modeling Group. The company is going through a couple of challenges right now. The stock is down close to 50% from a previous high, or it might in fact be down 50%. I would have to check the actual share price performance right now, but somewhere in that range. That's a very interesting one. Then I covered a German company that my fellow YouTuber Andrew Brown also talked about on his YouTube channel, I think a year ago or so. So you might want to check out his video on this name. This company is called Brockhaus Technologies, which is another interesting company, but a company that is also going through its set of challenges. I was looking at a company that may give you AI exposure. It's basically a cloud company for small and medium-sized businesses whose share price also got absolutely crushed more recently or ever since the post-pandemic period 2021, 2022. And this one is called DigitalOcean. I covered this stock in 3 parts on my blog. The first one, which outlines the business model itself and in quite a lot of detail, is also freely available. So I'm going to display it on screen. And if you have the time and are interested in this name, you may want to check out this blog. And then I was also publishing a new post, I think yesterday, so very recently, in which I talked about another German stock that just recently IPO'd that is growing incredibly fast, posting EBIT margins above 60%, so almost unheard of profit margins. But again, there's some hair on this investment as well, but it's an interesting one to add to your watch list, in my opinion. And with that being said, I'm going to wrap it up for today. I'll see you in a future video. Let me know if there's anything else you want me to talk about in future videos. I'm always looking for ideas and inspiration. I hope you have a great day, a great week ahead, and we'll talk soon.